Okay, let's unpack this. You know that feeling. You glance at the market headlines, everything just feels choppy.
Mm-hmm.
Inflation is, well, it's still here. Interest rates are bouncing around. If you're thinking about retirement income or maybe you're already there, your blood pressure might just tick up a bit.
It's a very real challenge right now. Finding
Sure.
steady income streams, it feels a lot different than, say, a few years back.
Yeah.
You need that income, sure, but you also need it to be resilient
Mm,
to hold up when the economic weather gets rough.
absolutely. And that's why this idea of a big, reliable dividend check, something like, I don't know, 9% or even more, it sounds like a total lifeline, right?
Oh, yeah. Very appealing.
Imagine that consistency. But finding yields that high
Mhm.
that you can actually trust, that feels like walking through a minefield.
It really does. So many of those super high yields are flashing red for a reason, usually trouble underneath.
A yield that high often signals, well, high risk. You've really got to look under the hood. Right. So this deep dive is kind of about cutting through some of that noise. We've got an article here, and it flags two companies as potential retirement income powerhouses.
Okay.
The source argues they could provide that sustainable high yield we're talking about, even if one of them doesn't technically hit 9% on paper right now.
Interesting. So it's not just the headline number.
Exactly. The real mission here is to understand why. Why does this article put these two seemingly quite different businesses in the same high-income, high-confidence bucket?
So we're going to explore the specific points the author makes, their business models, track records, and what makes them potentially resilient enough.
Yeah, resilient enough to keep delivering that income even when things get, uncertain.
Makes sense.
Think of this as maybe your shortcut to getting informed on these specific names and the kind of unique criteria the source is using to identify income potential. It's beyond just the headline percent.
Right. What's really driving it?
What makes their engine capable of supporting that kind of yield? Let's jump into the first one the article highlights.
Okay. The first company the source discusses is Enterprise Products Partners, ticker EPD.
Okay, EPD. Right away, though, the article throws a bit of a curveball, doesn't it?
Mm-hmm.
Its current yield is, what, around 7.5%?
That's right, about 7.5%.
So why is it on a list talking about 9% plus dividends? How does the source, square that circle?
Yeah, that's really where the author's core argument comes in. They say, look, while the headline yield is 7.5%, when you factor in EPD's history of reliably growing its distribution
Oh, the growth.
and the unique tax benefits of its structure, it's effectively equivalent to maybe 9% or even higher total yield potential, but over time.
Okay.
It's not just today's number. It's the sustainable growth plus that tax-efficient delivery.
Okay, that makes sense. So the yield on your original investment could climb past 9% because of the growth, plus you get tax breaks.
Got it. So what exactly is Enterprise Products Partners? What's the business? Right. It's what's called a midstream energy MLP. That stands for Master Limited Partnership.
Okay, jargon alert.
Yeah.
Ah.
Forget the jargon for a sec. Just think of them as operating the essential plumbing, the infrastructure that connects oil and gas producers to refiners and eventually to us, the consumers.
So pipelines, storage tanks?
Exactly. Pipelines, storage, processing plants. Crucially, they don't drill for the oil and gas themselves.
Okay, so they're like the toll road operators for the energy industry. Is that a fair comparison?
That's a perfect analogy. And that's absolutely key to their stability, according to the source.
How so?
Well, they generate stable, fee-based income. It's based on the volume of energy moving through their system.
Volume, not price.
Precisely. Regardless of how volatile the price of oil or gas is on any given day. That limited exposure to commodity price swings, that's a huge part of why the source sees them as such a reliable income machine.
Okay, that toll road model, that definitely feeds into the idea of a reliable engine. What else makes them stand out, according to this source? What are the criteria?
Well, the source points to a few things that seem to meet their powerhouse criteria, even if they don't list them all out at once right there. First, the track record.
Okay.
26 consecutive years of increasing distributions.
Wow, 26 years.
Yeah, that's incredible consistency over a long, long time. Second, distribution coverage, meaning they pay out only about, say, 55–60% of their distributable cash flow. Think of that as the cash specifically available to pay distributions after running the business.
Okay.
Keeping that ratio low means they have a significant buffer. They're not stretching thin to make those payments.
So cash left over even after paying out the dividends, or distributions in this case. That sounds solid, like a well-maintained engine. And you mentioned tax benefits. The article talks about tax-deferred distributions.
Yes, exactly. Because it's an MLP, a portion of the distributions is typically considered a return of capital for tax purposes.
Return of capital. Okay.
Which means you often defer paying taxes on that income until you actually sell your units. That can be a significant benefit, especially if you're in retirement.
Makes sense. Keep more cash now.
Right. The source even suggests holding MLPs like EPD in taxable accounts specifically to maximize this deferral. Plus, another point they make is significant insider ownership by the founding Duncan family.
Ah, so management's interests are aligned with the investors.
That's the suggestion. Their skin is in the game, aligned with long-term unitholder value.
And how does EPD handle inflation? That's such a headache right now. Is the toll they charge fixed or?
That's another point the source highlights, tying into that resilience idea. Many of EPD's contracts actually include inflation escalators.
Oh, interesting.
So as their own operating costs might rise because of inflation, their revenue can potentially increase too. It helps maintain the purchasing power of that distribution.
Okay, let me try and sum up EPD from the source's perspective. Headline yield is 7.5%, yes, but the argument is its consistency, 26 years of growth, solid payout coverage, those tax benefits, and an inflation hedge. It all makes it a kind of dividend machine with sustainable growing income power that could effectively give you a similar or maybe even better long-term income result than just grabbing a company flashing a 9% number today, but lacking that underlying strength.
That seems to be exactly the author's read on it. It's about the quality and the resilience of the income stream, not just the starting percentage.
Right. Quality and resilience. Okay. So that's EPD, a stable infrastructure play, tax advantages, consistent growth potential. Now, the other company, the source highlights, couldn't seem more different on the surface.
Right.
Yet the article puts them both in this powerhouse category. And this one actually does hit that 9% plus yield mark today.
That would be Ares Capital Corporation, ticker ARCC.
ARCC.
The source points out it's the largest publicly traded business development company, or BDC, in the U.S.
A BDC. Okay, let's break that down simply. What is a BDC at its core? What do they do?
Okay, yeah. A BDC is basically, think of it like a specialized lender. Instead of lending to huge corporations like Apple or, individuals for mortgages, they provide financing, usually loans, sometimes equity, to small and mid-sized private businesses.
Okay.
Companies that might not have easy access to traditional bank loans or the public bond markets.
So they're kind of like private credit funds, but you can invest in them publicly on the stock market.
That's a great way to put it.
Exactly.
And in exchange for taking on the, let's say, perceived higher risk with these mid-sized businesses, they earn higher interest payments on their loans.
Makes sense. Higher risk, potentially higher reward.
And a crucial part of their structure, it's required by law, is that they must distribute at least 90% of their taxable income to shareholders as dividends.
Ah, okay. So that income is practically forced out to shareholders by the rules. That helps explain the high yields we see with BDCs.
Precisely. And the source argues this legal structure really helps keep those dividends flowing, especially in certain market conditions.
So why ARCC specifically? There are other BDCs out there.
Good question. The article points to its sheer scale and diversification. It lends to over 450 different companies across various industries.
Wow, 450. That's a lot.
Yeah, that spreads the risk around significantly. No single loan defaulting is likely to sink the ship.
Okay, diversification is key. And who's managing all this? Is it a small shop?
No, it's managed by Ares Management. They're one of the world's largest alternative asset managers. We're talking hundreds of billions under management globally.
Okay, big player.
Right. The source suggests this indicates a deep bench of expertise, particularly in private credit lending. They know this space really well.
What about their lending track record itself? Does the source comment on, how risky their loans have actually been?
Yes. The article highlights ARCC's history of what they call conservative underwriting.
Conservative underwriting, meaning they're careful even though they lend to mid-sized firms.
That's the idea. Even though they're in that riskier segment, they are rigorous in assessing the risk of who they lend to. The source notes that ARCC has consistently covered its dividend with its net investment income.
Net investment income. That's like their profit from lending.
Basically, yeah. Think of it as the interest income they earn from all those loans minus their operating expenses and financing costs. They even pay supplemental or extra dividends in strong quarters,
Oh, bonus dividends.
which shows the income-generating capacity is pretty robust.
Yeah.
And crucially, the article points out that during the COVID panic, March 2020,
Yeah, stressful time.
ARCC maintained its dividend while some other BDCs were forced to cut theirs.
Okay, that's a serious stress test.
Yeah.
Maintaining the payout through that speaks volumes. It hits that payout stability across cycles criterion pretty hard.
Exactly.
But what's the main risk here? With BDCs like ARCC, what should keep an investor up at night, according to the source?
Well, like any lender, they are definitely sensitive to interest rates and, maybe more importantly, the overall health of the economy.
Right. If the economy tanks.
Default rates among their borrowers could climb. That's the core risk. If the businesses they lend to start failing, ARCC takes losses. However, the source highlights a key structural advantage for ARCC specifically.
Okay.
The vast majority of its loan portfolio is floating rate.
Floating rate, like adjustable rate mortgages, the rate isn't fixed.
Exactly like that.
Yeah.
So here's where it gets really interesting in the current environment, or the recent past anyway. As the Federal Reserve raised interest rates over the last couple of years,
Which they did, aggressively.
right, the interest rate on ARCC's loans automatically went up too. This directly boosted the income ARCC earned.
Ah, so rising rates were actually a tailwind for their income.
For their income generation, yes, it increased their capacity to pay those dividends. Now, the source acknowledges the flip side. If rates fall significantly, their income per loan could decrease.
Makes sense.
But they argue ARCC's scale, diversification, and management experience position them well to navigate different rate environments. And their history shows a strong commitment to the payout.
Okay, so the takeaway on ARCC from this article, currently yielding over 9%, backed by huge experience management, massive diversification, and a lending model that actually benefited from the recent rising rates. The risk is an economic downturn hitting their borrowers or falling rates eventually squeezing income, but the source sees resilience and a strong commitment to that dividend payout.
That's right. The author calls it, I like this phrase, a cash cow in a tailored suit.
Huh, I like that too.
It aims to generate significant income right now,
Okay.
looking sharp while doing it.
A cash cow in a tailored suit. Okay, so we have EPD, the steady energy toll road with growing tax-advantaged income,
Right.
and ARCC, the diversified private lender with a high floating rate yield. The article suggests combining these two. Why? Why pair these seemingly very different animals in an income portfolio?
Well, the author makes a case for diversification, but not just by company name. It's diversification by business model and by sector. You're getting exposure to critical infrastructure. That energy midstream piece with EPD, which tends to be less sensitive to the ups and downs of the economic cycle and commodity prices.
Right, more stable.
Alongside exposure to private credit lending with ARCC. That offers a higher current yield and benefits from different factors like, as we discussed, interest rate movements, but also credit spread.
Credit spreads. Okay, can you quickly break that down? What does that mean for ARCC?
Sure. A credit spread is basically the difference in interest rates between super safe debt, like U.S. Treasury bonds, and riskier debt, like the loans ARC makes to these mid-sized businesses.
Okay, the risk premium.
Exactly. When the economy feels uncertain or shaky, that spread often widens. Lenders demand a higher premium, a higher interest rate, for taking on more risk.
Right.
ARCC can potentially thrive when spreads are wider because they can charge higher interest rates on the new loans they're making.
Got it. So pairing EPD and ARCC is kind of combining EPD's predictable infrastructure-backed cash flows
Yeah, the stability.
with ARCC's potentially higher floating rate private lending income, which is also sensitive to things like credit spreads. You're mixing stability with a different kind of yield potential driven by different economic forces.
Yes, precisely. It's about trying to build a more robust, more resilient income stream overall by not relying on just one mechanism. The goal is payout sustainability, but with decent long-term potential too.
Okay. Now, the article does address some common pushbacks, some criticisms against these kinds of investments. First, the classic one, a 9% yield is just too good to be true. Smells fishy.
But look, often it is. That's a healthy skepticism to have.
Yeah.
But the source argues it's not always the case. They say that critical difference is looking beyond just the number printed on the screen.
Yeah.
Okay, look at the underlying financials.
Like the coverage ratios we talked about.
Exactly. Strong cash flow coverage, experienced management teams, a solid balance sheet. They make the case that both ARCC and EPC, despite their high yields or effective yields, actually meet these fundamental criteria.
Okay, fair enough. What about the tax complexity with MLPs, like EPD? People dread those K-1 forms.
Yeah, the source is upfront about this. They definitely acknowledge that K-1s mean more complex tax reporting compared to, say, a standard stock dividend reported on a 1099 form.
It's a hassle.
It is. It's definitely a hurdle for some investors, no question. But they reiterate that if you're willing and able to handle the paperwork, that tax-deferred income feature we mentioned can be a really significant financial advantage over the long run, especially in retirement.
Right, the trade-off. Hassle versus potential tax savings. And for BDCs like ARCC, the concern that they're risky if interest rates fall. We touched on that.
Yes, and the source agrees there's sensitivity there. If rates fall significantly, ARCC's floating rate income structure means their earnings per loan will likely decrease. That's just math. However, they circle back to ARCC's management quality, that huge diversification across 450-plus companies, and its historical commitment to maintaining its payout through various cycles. The argument is it's probably better positioned than many other BDCs to navigate lower rate environments if and when they arrive.
Okay, so this all ties back to the article's core powerhouse criteria for a retirement income stock. Based on our chat, what were those key non-negotiables they listed? Can we recap those?
Sure. The source seemed to be looking for companies that, one, yield 7% or more currently, with a clear potential for the total return, including growth or tax benefits, to reach that 9% plus level effectively.
Okay, yield target.
Two, have strong payout coverage ratios. They need to be paying out significantly less cash than they actually generate. That safety buffer.
Makes sense. Buffer's good.
Three, backed by high-quality experienced management, people who know what they're doing.
Crucial.
Four, demonstrate payout stability across different economic cycles. They've weathered storms before.
Like that COVID example for ARCC.
Exactly. And five, offer some mechanism, some feature for inflation or interest rate hedging, like EPDs, inflation escalators, or ARCC's floating rate loans.
Got it. And the article's conclusion is that both Enterprise Products Partners, EPD, and Eris Capital, ARCC, despite being very different, they check enough of those specific boxes to be considered potential retirement income powerhouses.
That's the author's assessment, yeah.
Yeah.
They aren't necessarily presented as the most exciting, shoot the lights out growth stocks. The focus is squarely on the resilience and the reliability of the income stream for peace of mind.
Right. So for that specific part of your portfolio, the part designed to pay you to provide that steady income you might potentially live on, rather than just focusing solely on capital appreciation. The source suggests these are two names worth digging into further yourself.
They frame it as finding businesses built with engines, strong enough to weather economic storms and just keep that income flowing consistently.
Okay, so let's wrap this up. We've taken a deep dive into this source's argument for two potential income powerhouses: Enterprise Products Partners, EPD, and Eris Capital Corporation, ARCC.
Two very different models.
Very different. Midstream energy infrastructure on one hand, private credit lending on the other. We've unpacked their unique strength, the specific risks the article brought up, and, I think most importantly, the criteria the author used.
Right, the why.
Emphasizing that sustainable high income, according to this source, is really about the underlying engine and its resilience, not just the current yield percentage flashing on your screen.
And we've seen how that translates into looking beyond just the raw number.
Yeah.
You have to look at factors like consistent payout coverage, the quality of management, that historical stability through different cycles, and how they might handle things like inflation or interest rate shifts.
Yeah, it's a powerful reminder, isn't it? Finding truly sustainable high income for retirement isn't just about spotting a big number. It's about really understanding the fundamental business driving that income.
And its ability to endure.
Its ability to endure different economic conditions. That seems key.
Absolutely. It requires that deeper level of analysis.
So here's a final thought to leave you with. If finding sustainable high income requires understanding not just the percentage yield, but the underlying business model and its resilience to different economic conditions, what other traditional income-generating assets, maybe things you already hold or are considering, might you need to look at through a similar skeptical but informed lens?